Hello everyone, this is Juan Sarmiento and today is Friday, January the 20th. Okay, first I have three candidates, but let's go through our current positions and see what needs modifying. It's already in alphabetical order, so I just click anywhere, and if you have this link, it will take you to the proper Analyze tab. Okay? This is Caterpillar, and you can see that we have February expirations and we have a few longs here. So let me just show you two short calls, two short puts expiring February the 10th. And we have two long calls here at 220, and obviously because the stock was reached as much as 260, we did a roll up. But now we have two calls here, two short calls, two long calls. As far as the puts, we have four of them, and that's perfectly all right. You can see that the um, the current price is sitting at the lower where the smiley face is at the apex. I would say is sort of the lowest point there. Um, that means our delta is pretty neutral, and if reflected here, minus 0.35 is quite close to neutrality. Now, February is due to expiring in February the 10th, the shorts, which is 21 days from now. There's plenty of time for me to change that around. So as long as we have delta neutrality, that's what we are looking for. That's what we want to do. Why? Because if the market goes up significantly, we could make money. If the market collapses, we could make money too. If it goes sideways, well, we're wearing off our shorts. Okay, that's the goal here. By having these shorts, we're making sure that the longs have as much time as possible to get us some profits. Okay, to make them act. Let's go to CRM. Okay, CRM. Actually, I was thinking that could be one of my trades, but no, nothing. We already have it. So we have February expirations, May. So the shorts, there's plenty of time for them to act, and right now they're just eroding as the market is trading precisely at the strike price of my shorts and longs for that matter. So we let them be. We're losing $230 right now, but that could change. Okay, so let it be. Let's go to Cisco. And in the case of Cisco, our deltas here are negative. And let's take a quick look at the chart. Do I believe that Cisco could bounce? Yeah, it might be bouncing here. So what do? How do we neutralize our deltas? Well, you can add some short puts. You can sell some of your current puts. I think we could add puts in this case. Let's see. If I add that, let's say short two of them. Let's sell them, two puts, and then that neutralizes my deltas a little bit. Okay, let's do a couple more, and then that's closer to neutrality. I'm willing to live with that. If the market rallies from here, yeah, it could do well. So the problem is that we're only getting 39 cents. That's not a lot. What if we sold our long puts here? Just sell one, deselect the short, and we go from 116 to 180. How about if we do two? This is how we would neutralize it. Okay. All right. So by neutralizing that, if Cisco happens to rally strongly, we could make good money. If it collapses, it might end up here in my code. So I think I want to do that, right? Let's deselect the shorts. Let's just sell 3 longs. And that makes my trade more delta neutral, only 9 negative. Okay, great. Let's proceed with Gilead. In the case of Gilead, I have a 80 put here, only one. And if I am correct, the stock has been going down significantly. Oh, okay, so we can sell one too. If we sell a few puts, we could neutralize my deltas. And neutralizing my deltas is, in essence, not just neutralizing, we're taking profits, we're taking money off the table. And if I do 3 of them, my deltas go to minus 98. Yeah, let's do a few more. You see we have 9 short calls, 1. I want to do a few here. We can do as many as 8. We have 4. I would do, so that it matches my long puts, I could do 6. My delta becomes neutral. And let's do that. There it is. And that's a very neutral sort of trade. Yet, if the stock goes down significantly, we could make good money there. Okay? If it goes higher, we can make money too. All right, let's move on to GS. All right, this stock has been moving down significantly here. 350 is my longs, my shorts, 350, 350. Obviously, we have this 340 March puts. Yeah, obviously I rolled it down as it was going down. I think I want to leave it the way it is right now. It's minus 15 delta and the stock is going down rather strongly. They reported earnings and it wasn't good. Yeah, let's leave it like that. Yeah, we are right here, and yeah, it looks good. You can see that the delta is close to neutrality, a little negative, and the stock is negative, going likely to break below the Ichimoku cloud. Okay, let's leave it like that. And then Starbucks looks like it's going down significantly. And they are expiring today. Oh, curious, okay. Good, because what we do is roll the calls only, analyze rolling. Come to think of it, this is, we have been losing money on this one, $1,000. And they're sort of expiring today. So what I'm going to do is I'm going to close this position. Analyze the opposite. And I say, okay, it's a loser, no need to extend my losses anymore. And just make sure that this position, that all I did was I have my existing position here, right? Simulation. I say analyze opposite, and that will, as you can see, it flattens out the existing position. The current trade is flat. It means my position, my trade here will close the existing positions. Yeah, let's do that. I just, sometimes you need to cut your losses short, and that's the end of that. As good as it looks, because it's right here in the smiley face. If that doesn't work in just a few minutes, you can also close the call side first and then the put side second. All right, let's move on. I have some trades that I wanted to consider here first. Let's go to the trade tab and add. We're going to add TSM. I need to put my light on just a second. TSM. Something wrong with my typer here. Okay, TSM. That's Taiwan Semiconductor. Let's take a look at the chart, and you see it's been moving strongly, and the volatility is low. Good. So, yeah, this could be a good trade. They recently reported earnings. They beat expectations. So let's go to our spreadsheet. First, create the trade. All right. So let's go to the Add Simulated Trades, and we're going to go. Our shorts could be 30 days, so they could be here 28 days, that's the February 17th, and my longs 91 days, the April 21st. And we're gonna do add the strike price 90, and I say analyze trade. No, we need to go to the trade tab, and instead of analyzing trade, we're gonna say create a trade. Buy custom, and because you know how I created this custom trade, just say Genie, and that creates the trade, presumably the trade that I want. Let's analyze that. Okay, so the shorts, I said February 3rd here, but no, we want the one with 28 days to expiration. That's February 17th. And the longs 90 days to expiration, that's April 21st. All right, unlock it, and that's my cost. All right, so now we can copy this, copy it, and take it to my spreadsheet. TSM. And we put our trade here, paste, in case we want to come back to it. All right, so the cost is $16.25. And let's say we do 6 of them, 6 lots. Yeah, 6 lots. That will be 6 shorts and 12 longs. Okay, the strike price is 90. You can put it here if you want, just to remember that. And the shorts is February 17th, 2023. And the longs are April the 21st, 2023. Perfect. Okay, now we need some details here. Let's go to the trade tab, the chart, and see the earnings 1.82 versus 1.79. So 1.79 was expected. 1.82 was the real data, and that's 1.7. It says do not trade. The earnings came better than expected, but it's still a little under. So let's put that an orange. color here because it's not perfect. Let's go to the volatility skews, analyze, and that's the trade I'm suggesting. So let's come over here and enter it here. The back month, meaning the April ones, have 33.6. I'm copying from here. Look at the volatility here at the bottom right corner of your screen, 33 and 28. Okay, so 33.6 for the calls and 28.5 for the puts. And then the calls, 32.3. Hold on a second. I have this in Spanish, so US. Okay, so 32.3 versus 28.4. Okay, so you can see that the difference is minimal. So that's a trade. Okay, the difference between front month volatility and back month volatility is only 0.7%. I average both calls and puts, and that's what I get. Okay, a difference of 0.7. That means we can't trade that. Liquidity is simply when you create a trade, you see mid and natural, and that's important because it would help you determine if this is easy to get in and out of the trade. 1624, that's 1619 versus 1646. Okay, that's 1.6, is less than 5%. You can trade it, no problem. The only thing missing is the current IV percentile. Let's go to the Analyze tab, Trade tab, sorry, and scroll down. And you can see here the current IV percentile is 0. That means it's as little volatility as we can make it. So that's 0 here, and so therefore we can trade it. The IV is low, and if for whatever reason the volatility spikes, we will make money. Okay, so we're gonna make 6 of these lots. So that what that means is you create duplicate order, confirm and send, and say multiple accounts, so that then you can change that to 6, I said, right? And that's 9.7, which is very close to 10% of my account. Okay, so then I send that off. Okay, we wait for it. Another one that I wanted to take a look at is Adobe, and I do not have a trade on that. Okay, Adobe is moving up. All right, let's create the trade tab, and we are going to do the same. Okay, the February 17th, April 21st, and we need to trade the 350s, the closest to the strike price, to the current market price, by custom and Genie. Of course, you can create this trade by hand. Okay, it's a little high on the call side here. Let's see what it turns out to be. So let's copy the trade, and we can only do one lot on this one. Why? Because it will be close to 10% of my account. See, if we double click here, I'm going to put that number here, 69.08, and just 1 here. Perfect. 69 is less than 10% of my account. So we're going to do 1 short, 2 long. So that means 1 short straddle, 2 long straddles. The strike price is 350. And the larger the strike price, the more it's going to cost us. Okay, the dates are the same. Wait a minute, I'm using February 24th. Let's change that to February 17th for the short. Yeah, that would be cheaper, you see. We spend less money then, and that's a good idea. Let's copy that and take it to the spreadsheet, paste that there. Oops, maybe I should just copy it. Oh, I do have an Adobe here. Okay, 6375. Okay, 1-1, and we put this February the 17th. $3.50. There we go. Okay, so now we see, look at the the earnings. The last earnings is 3.6. That's great. It was expected to have 2.78. Yeah, we already had that, so the difference is huge, 29%. Okay, let's look at the volatility skew, and that's in the Analyze tab, and we have these numbers here at the right corner, bottom right corner of your screen, and let's enter that information here. 37.6 versus 31.8 versus 38.1, 31.8, and it's quite balanced. In fact, it's a little under to our favor because the shorts are more, and the shorts are a little more expensive, not by lot, a lot though. Okay, now the liquidity, I can tell you that Adobe is going to be liquid, but just the same, confirm and send. No, create duplicate, and that gives us a mid and the natural right here, and we're going to enter it in our sheet. The mid is 63.7 and the natural is 64.65, and of course that is tradable. And then the current IV percentile, we go to the trade tab, scroll down, and you can see here current IV percentile is 7, and it needs to be less than 15, so that looks great. So let's enter that trade. And this is a trade I was intending to enter before, but it didn't fit all the conditions. Now it does. You see everything is green, so we can trade this. Let's go to the Analyze tab and unlock it, because now it's going to be 63.78. Confirm and send. All right, let's go and reanalyze what is it that we have here. The start box, I said that I was going to split it, the call side and the put side. So let's cancel that. Let's cancel it. Let's go the Adobe field. Let's see if the TTS would fill. All I need to do is cancel, replace, unlock it, and you can increase a couple of cents and send it. If that doesn't fill, you keep increasing the price until it gets filled, or you give up and say I don't care. It's up to you. Okay, let's start box. Let's say Analyze, and we are gonna sell first the call side or the put side, whoever is more expensive. So Analyze rolling for the calls, and then we say okay, March 17th is my longs, in my shorts January today, and you can see that I need to say this custom because I am selling 9 calls and buying back 5. To confirm that that's the trade we're doing, select only the trade we're doing and select only the calls here. Deselect the puts, and that should give you a straight line. Great. And we get 52.70 in credit. For the put side, let's duplicate this, analyze trade, and then change these two puts, unlock it, and make sure that it's the right number of options. I'm selling 10, I'm buying back 5. Okay, let's do the long one first, the big one first, which is the call side. And you can wait until it fills, adjust the price if you must, reducing the price, until it gets filled. Okay, adjust the price also on your long position or trade. And you keep doing that until it gets filled. I will make sure that it does get filled before I quit this for the day, but there's no point in showing you all too much. I just play with it until it gets filled, like this. Increase the price by 2 pennies until it gets filled. The short, cancel, replace, reduce your ask by 5 cents, something like that, until it gets filled. Okay, and when it does, it does. That's all for today. Thank you very much for joining me. See you next time. Bye bye.